Hello, welcome back to the show. So in today's video, I'll be talking about why Google is a dying business. So in today's video, I'll be covering a few things. We'll be covering why Google is a dying business, Google's valuation today, as well as some questions that you guys have left me in the comment section below. So let's talk about why Google is falling first. So Google is falling because the Apple representative Eddie Q, he basically testified in court saying a few different quotes. So this was what he said. He said that Apple is exploring adding AI search to its browser, and Apple and Microsoft have moved to a multi-year agreement on search. So this is causing panic in the markets because everyone is thinking that Apple is going to remove Google as the default search engine in all your different Apple devices over here. But this is Eddie Q back in 2023. So Eddie Q has been actively defending Google. He wants to defend Google so that Apple can keep the money. So this is back in 2023 that says Apple's Eddie Q defends default search contract with Google as best option for consumers. So this was what he said in 2023, and he is likely doing the same as well. I don't think he's doing this to threaten Google in any way, shape, or form. So this is solely my opinion, but this is what I think Eddie Q is trying to do. Eddie Q is trying to downplay the Google monopoly so it doesn't have to cut the deal with them, that's one. Because Apple and Google, they have a $20 billion agreement every single year for Google to basically pay Apple to be the default search engine in all your different Apple devices over here. And there is a 100% margin profit over there, and it represents around 20% of their total net income over there. So he's trying to save Apple from a lawsuit from DOJ as well by trying to shift Apple out of the picture. But the streets are currently thinking that this is a play for Apple to remove Google as the default search engine. So this is what big tech always do to try and downplay the situation and downplay their monopoly over here. This is by Peter Thiel. Peter Thiel, he's the founder of Palantir. Over here, he's talking about why competition is for losers.
A lie you tell as a non-monopoly is that we're in a very small market. The basic lie you tell as a monopoly is that the market you're in is much bigger than it looks. And so typically, if you want to think of this in sort of set theoretic terms, you could say that a monopoly tells a lie where you describe your business as the union of these vastly different markets, and the non-monopolist describes it as the intersection. So that, in effect, if you're a non-monopolist, you will rhetorically describe your market as super small. You're the only person in that market. If you have monopoly, you will describe it as super big, and there's lots of competition in it. So some examples of how this works in practice. So I always use restaurants as the example of a terrible business. And there's always, sort of my ideas. Capitalism and competition are antonyms. Capital is someone who accumulates capital. A world of perfect competition is a world where all the capital gets competed away. So you're opening a restaurant business. No one wants to invest because you just lose money. So you have to tell some idiosyncratic narrative, and you will say something like, well, we're the only British food restaurant in Palo Alto. So it's British, Palo Alto, and of course that's too small a market because people may be able to drive all the way to Mountain View or even Menlo Park. And there probably are no people who eat nothing but British food, at least no people who are still alive. And so that is, that's a sort of a fictitiously narrow market. There's sort of a Hollywood version of this where the way movies always get pitched is, okay, it's like a college football star, joins an elite group of hackers to catch the shark that killed his friend. Sorry. And so now that is a movie that has not yet been made. But the question is that the right category, or is the correct category, it's just another movie? In which case, there are lots of those. It's super competitive, incredibly hard to make money. No one ever makes money in Hollywood doing movies. It's really, really hard. And so you always have this question about, does the intersection, is it real? Does it make sense? Does it have value that one should ask? And of course, there are startup versions of this where the sort of the really bad versions, you just take a whole series of buzzwords, sharing mobile social apps, you combine them, and you have some kind of narrative, and whether or not that's a real business or not is generally a bad sign. So it's almost this pattern recognition. When you have this rhetoric of this sort of intersections, it generally does not work. The something of somewhere is really mostly just the nothing of nowhere. And it's like the Stanford of North Dakota. One of a kind, but it's not Stanford. So let's look at the opposite. The opposite lie is if you are, let's say, the search company that's down the street from here and has about a happy 66% market share, and is completely dominant in the search market. Google has not almost never describes itself as a search engine these days, and instead it describes itself in all these different ways. So it sometimes says it's an advertising company. So if it was search, you'd say, wow, it's like it has this huge market share that's really, really crazy. It's like an incredible monopoly. It's much bigger than a much more robust monopoly than Microsoft ever had in the 90s. Maybe that's why it's making so much money. But if you say it's an advertising market, you could say, well, there's search advertising is 17 billion, and that's part of online advertising, which is much bigger. And then all U.S. advertising is bigger. And then by the time you get to global advertising, that's close to 500 billion. And so you're talking about 3.5%. So a tiny part of this much larger market. Or if you don't want to be an advertising company, you can always say that you're a technology company. And so, sorry, let me see. And the technology market is something like a $1 trillion market. And the narrative that you tell as Google in the technology market is, well, we're competing with all the car companies with our self-driving cars. We're competing with Apple on TVs and iPhones. We're competing with Facebook. We're competing with Microsoft on Office products. We're competing with Amazon on cloud services. And so we are in this giant technology market where there's competition in every direction you look. And no, we're not the monopoly the government's looking for, and we should not get regulated in any way whatsoever.
So what he's basically saying is that the monopoly will always claim that they're in competition, which is what Apple and Google are doing over here. This is what I believe. So Apple is trying to basically downplay Google. They're trying to play it such that Google looks like it's not a monopoly. Google looks like a competitor in your AI space over here. And that is the agenda that they're trying to push to the DOJ over here. The sell-off looks a bit overblown to me, but then again, the stock will go a lot lower because Meta, another social media company, dropped around 14 times earnings back in 2022 when it dropped all the way to around $88 or so. Currently now it's at around $500. So you could see a lot more downside in this stock before there's more upside. Currently now Google is trading between a 16 to 17 times earnings. For me, the fair value for Google should be between 22 to 24 times earnings. So this is an interesting Google story that I found online. So Google over here, they've been impacted by search. So over here, this portion over here, it says, the expert views OpenAI as a real threat to Google search, noting a clear shift in user behavior towards conversational AI. While Google has long worked on similar tech internally, fear of hallucination and brand damage slowed deployment. OpenAI launch forced a cultural reset at Google, pushing the company to move faster, especially with AI overviews. While Google's AI search has improved, OpenAI, according to him, still offers a superior conversational experience with more natural and explanatory and confident answers. The expert believes AI overviews are highly monetizable, but not in the same way as traditional Google search ads. The real opportunity lies in how AI enables more detailed, context-rich queries and follow-ups, which can drive better targeting and dynamic creative generation. By leveraging its massive advertiser base, creative assets, and automation tools, Google can tailor ads in real time to match user intent. This won't impact near-term earnings, but over 1 to 2 years could be extremely powerful for Google over here. So what he's basically saying is that Google has an extremely wide base in terms of its distribution. It has the largest advertising segment over here. It has the largest pool of advertisers. And what they can do is they can leverage on AI to basically just improve the business itself by creating AI-generated advertising, AI-generated ads, which is what it's not doing right now. So this is a very interesting take that I have seen over here on Google. It is definitely doable, and that is why the company has been investing quite heavily into CapEx to try and improve all these AI offerings over here. So let's talk about Google's valuation. I'll be doing a by parts analysis. So let's start with YouTube over here. YouTube, without the subscription part, is around 10.5 billion in net income every single year. Netflix does around 9 billion, and Netflix now currently trades at around 54 times earnings. YouTube has a superior business model, but let's say it trades at around 35 times earnings. That's 367 billion for YouTube over here. Next portion will be Waymo. So Waymo, the last valuation that they had was around $45 billion. Google doesn't own the entire Waymo company, and that's why they were trying to raise money for it at a $45 billion valuation. So let's say Waymo is at around 45 billion. Google Cloud did around 6.6 billion net income in the trailing 12 months, and they will likely expand their margins over time. So you can see this number exploding over time as well. Amazon is currently trading at around 30 times earnings. Microsoft is trading at 33 times earnings. So let's say Google Cloud trades at 30 times earnings, assuming the trailing 12-month earnings of around 6.6 billion, that's around $198 billion for cloud over here. So if you're to sum them up, that makes out to be around $1.1 trillion for Google search. And so for Google search over here, the question is simple. Your Google search and their subscription portions basically adding up to be around $100 billion every single year. And that makes out to be around 11 times earnings for Google search. So the question now is this, is paying 11 times earnings for Google search too much? Google is probably a business in decline, but the problem is how much. No one knows how much the decline will be. Investors like myself today are betting on the fact that Google will continue to prove people wrong in terms of the numbers. But on the contrary, you could see something like this, where a company just holds for a few years and then there is suddenly a sharp decline over here. So my worst case for Google is around a $70 stock price. That is assuming they hold YouTube, they hold Waymo, and they hold Google Cloud as well. So this assumption is assuming that search goes to zero. So currently now you're paying around $80 per share for Google search, and you're paying around at 11 times earnings for Google search and subscription. I think for a company that is growing at 11 to 12% in terms of their organic revenue growth, paying around 11 times earnings is definitely undervalued. There's no reason why this company should be trading at this valuation. And if you're doing a by parts analysis, it clearly shows that Google is a company that is extremely undervalued today. So this is my Google thesis. My Google thesis has always been a diversification out of search with rapid growth in cloud, YouTube, and Waymo as well. The numbers in those portions are doing fine, and as long as they are doing fine, I will continue to hold the stock. They have arguably the greatest distribution networks in the entire world. You can basically just tap on a user base, advertising base, and just monetize all the AI offerings that they have at whatever price they want to because they have the base. And so for me, I think Google will be one of the front runners in terms of AI because they have the greatest distribution networks, similar to Microsoft, similar to Amazon as well. And that's why I still remain bullish on this company over here. So if Google lose, then here are some winners that you could consider as well. So if Google loses search volume and push up ad prices to compensate for losses, the cost per click for ads will go up. And then you will see other advertising companies like Meta, Amazon winning as well, without so much DOJ scrutiny as well as disruption risk over that. So that's why I hold Meta and Amazon as well. These two stocks will gain if Google basically starts to erode over time in terms of the moat. So last portion over here, I'll be covering some of the questions that you guys have left me in the comment section below. So the first one over here is this. Hi Guan, outside of your Singapore holdings and ASML, do you own or track any other non-US stocks like Brookfield or Nintendo? Nintendo is in Japan, so the problem with all your Japanese stocks is the currency depreciation. So if you were to look at the USD JPY over the past 10 years or so, it has depreciated massively. The USD is already depreciating at such a rate as compared to my home currency, which is the Sing dollar over here. So that's why I'm not intending to buy any Japanese stocks unless they massively provide me with upside from here. For Nintendo, I think it's a company that's trading at quite high valuation. The last time I looked at it was around 40 times earnings. As for Brookfield, Brookfield is a company in Canada. They are an asset manager. But the problem with the business is I don't understand the business at all. And the business just seems a bit too shady and too overcomplicated for me. So for Brookfield over here, I would rather just buy another company like Berkshire, for example. Berkshire has your legendary Warren Buffett status, or another company like Markel, for example, that does something similar to Berkshire as well. So for Brookfield, I wouldn't touch it. I don't understand it, and the price to book looks a bit heavy on that stock as well. As for international diversification, I'm looking at some Chinese stocks. So for example, I've been looking at Alibaba as well as Baidu. Those two stocks are the ones that I'm tracking right now. As for Japanese stocks, I'm looking at some of them as well. But again, the currency depreciation is the one that's holding me back from buying all these Japanese stocks. A lot of them are quite undervalued. Next question, what do you think about Whirlpool as a long-term hold? So if I'm not wrong, Whirlpool, what they do is they sell household appliances, but I've looked into the fundamentals of Whirlpool. Whirlpool's fundamentals have been declining over the past few years or so. So they've recorded negative earnings this year, but I think the negative earnings is due to some form of asset write-down or them divesting some form of business over here. But for Whirlpool, if you're to look at just the revenue itself, revenue has been stagnant all these years. Their gross profit have been dropping over time over the past 5 years or so. So for me, I think Whirlpool is an avoid. It is a company that is similar to Pool Corp. Pool Corp is another company that I've been looking at as well. And Pool Corp for me is a greater monopoly than Whirlpool over here. Whirlpool, you have a lot of other different competitors. For Pool Corp, there's almost no competitor in the US. They hold a monopoly in terms of your pools in the US itself. So for me, if I'm looking at an interest rate bet where people spend more money on consumer discretionary items when interest rate drops, such as your pools, your cars, and all that, I'll look at Pool Corp. Pool Corp is a company that interests me. Warren Buffett bought it, so it is definitely of high quality. Last one. Would you think Visa and MasterCard has spending risk tailwinds should the economy gets into a recession and people start spending lesser as a result meanwhile? So for Visa and MasterCard over here, if you were to look at the last 20 years of retail sales, the only times where the retail sales dropped was in fact in a recession. So in 08 it dropped, in 2020 it dropped as well, and in 2022 it didn't drop but it was almost flat. So for Visa and MasterCard over here, of course when consumer behavior drops, when consumer spending drops, then Visa and MasterCard's revenue will drop as well. But for these two businesses over here, they will just survive any sort of economic environment, and the risk of a recession shouldn't be weighing on your decision to invest because recessions they come and go, it's a business cycle, but for quality business, they will stay forever. So I hope you guys have found this one useful and invest safe.